It says, in order to reduce audit risk to an acceptably low level, the auditor should respond to the assessed level of risk in two ways, at the financial statement level and at the relevant assertion level. So at the financial statement level versus at the detailed assertion level. All right, at the financial statement level, the auditor will consider the users of the financial statements and the purpose for which they will be used to determine if management may have an incentive to over or understate the results of operations and financial position. Is management concerned with overstating or understating the results of operations income statement and financial position is your balance sheet? To address the risk of material misstatement at the financial statement level, some of the auditor's responses to reduce audit risk to an acceptably low level. Again, we're trying to reduce audit risk. Audit risk, IR, CR, DR. So we're trying to reduce our audit risk to an acceptably low level. A, or the first bullet, an increased need for professional skepticism, question and doubt everything. Consider assigning more experienced staff. Increase the level of supervision. Incorporate more unpredictability in audit procedures. That's important. You don't want the client to know that, oh yeah, every year they do the same test week, every year they do the same accounts, every year they have the same level of materiality. We want to be unpredictable. It's kind of like saying we're going to come out and do an inventory observation, but we're not going to tell you which location we're going to count first. Adjust the nature, timing, and extent of further audit procedures such as shifting interim testing to year end. So what that means is, instead of doing interim means before the end of the year, and then rolling it forward, it says, you know what? If we want to be more cautious, do it at the end of the year. Because the balance at December 31st is more accurate than the balance October 31st, happy Halloween, and rolling it forward. The auditor should design and perform further audit procedures whose nature, timing, and extent are responsive to the assessed risks of material misstatement at the relevant assertion level. The auditor should consider, so here's what we're considering. It says here, the significance and probability of the significance probability that a material misstatement will occur, the characteristics of the class of transactions, account balances, and disclosures, the nature of the controls used, whether the auditor needs to test the operating effectiveness of the controls in preventing or detecting material misstatements. Now, when we talk about nature, timing, and extent, nature means what? Timing, when, extent, how much. It says nature of audit procedures. This includes both its purpose and its type. The nature of audit procedures is the most important consideration in responding to the assessed risks. The higher the auditor's risk of material misstatement, the more relevant and reliable the audit evidence should be. Timing talks about when we're going to do it, and that means should we do it at the end of the year or interim. The higher the auditor's RMM, the closer to period end substantive procedures should be performed. Now, the higher the RMM, that means if reliance is low, RMM or control risk is high, that means we want this low. We better do more of this. When are we going to do that? Closer to year end. Extent, this refers to the quantity of specific audit procedures. This is based on the auditor's judgment, and the auditor should consider the tolerable misstatement, the assessed risk of material misstatement, and the degree of assurance they plan to obtain. So you'll see that all of that, again, deals with information that we've dealt with in the past. So as we're looking at that, we're concerned, again, with looking at these risks at both the financial statement level and also the relevant assertion level. To address the risk at the assertion level, the auditor considers the individual elements of the financial reporting. Operating items, account balances will be scrutinized. The type of likely misstatements also determines which assertions are most effective and which procedures will be most effective in obtaining the evidence as well. Assets like inventory may represent risk if they are susceptible to theft, in which case the auditor will concentrate on the existence assertion. So when we talk about existence, for example, the auditor determines if there are control procedures in place that can be relied upon and that, if operating as designed, would be effective in preventing theft. The auditor may apply substantive procedures such as comparing physical observations of inventory to recorded amounts and performing analytical procedures to determine if the relationships among inventory, cost of sales, and gross profits are reasonable. For sales, and we go through a couple of examples like that. Now, as mentioned earlier, the auditor may use either a substantive approach or a combined approach. A substantive approach means you're not going to rely, more substantive, boom. Versus a combined approach is where you're doing internal control testing as well as substantive testing. It says a combined approach For certain relevant assertions and risks, only substantive procedures will be performed. This may occur because either there are no effective controls or cost-benefit. In other situations, both tests of operating effectiveness of controls and substantive are used. That's called the combined approach. That's where you're looking at both internal control and substantive testing as well. So you can kind of see how that's all integrated.